There's no way to sugarcoat it. That was an ugly month of September. Virtually every asset class was down. Historically, September's the weakest month for equity returns, and it certainly lived up to that billing. So we are going to unpack the month that was. It's the quarter end of the third quarter. There's a lot to talk about. I tried to pare this down so it's concise and on topic. So we shared the most meaningful graphs in our opinion. So we're going to cover where we're at, how this market action stacks up with previous bear markets. Also look at the fixed income markets as well. And kind of the overarching theme this year, this is the year of the opposite. The year of the 180 is what I've coined it, where everything we've known to be true the last 12 years has shifted. And you can go on down the list. I mean, you think about it. In 2021, people were opening Robinhood accounts, trading meme stocks that had little earnings, and these moves were going crazy. People were speculating. They were buying NFTs, which are digital photos, basically, for hundreds of thousands of dollars. Now people are scouring the web to buy treasury bonds and savings bonds. So what a difference a year makes in the risk tolerance, the risk appetite for investors. And you think about, again, the last decade where we had low rates and low inflation, that's all changed. We went from a speculative market, all-time highs in 2021, to an ugly bear market across all asset classes. So not an easy environment. Let's get into the graphs. Okay, so we have a couple benchmarks here, just kind of a snapshot. I'm recording this on Wednesday, 9/28, so the 28th of September. So if these numbers are a little different, that's why. So the Barclays Bond Ag Index, a snapshot of the US bond market, is down a little over 14%. The S&P is down almost 23%. And the NASDAQ, a basket of tech stocks, down almost 31%. And you can see the month of September right here has been pretty nasty for bonds, but specifically stocks. I mean, this is a pretty gross move down, almost 10% down, about the same for the NASDAQ. So certainly a very difficult month for investors. And this is the path that we've taken. So it hasn't been straight down, which is not uncommon for a bear market. So what we're going to do here is look at how 2022 bear market stacks up with other bear markets. And we're going to look at a similar path. So what we've done post World War II is outline every bear market where there's been three drawdowns of 10% or more. So this isn't necessarily to say, hey, this year looks like 1982 and this is what's going to happen, but I think it's important for people to understand the range of potential outcomes. So for similar market action like 2022, we're going to look at, again, post-World War II bear markets where there are three drawdowns of 10% or more, and then the market found a bottom. Okay, so I apologize. This one is blurry for some reason. This is the only chart that showed up a little squirrely. So there were 5 World War II bear markets where you've got 10% drawdowns. And that was starting in January 1973, November 1980, August 1987, March 2000, and October 2007. So those dates that I rattled off were the start of the bear market. And this one is November 1980 to 1983. This one is interesting because a lot of people compare the early 80s to what the Fed is trying to do now. Of course, different drivers of the economy, a different time. This is a long time ago. This is 40 plus years ago. But you can see, again, you've got the 3 legs lower. And this was the inflection point that no one saw coming. And I wrote about this a couple of weeks ago where the Fed actually pivoted and unexpectedly cut rates as inflation normalized. So inflation stopped going up, it started going down, and the Fed pivoted. Now, no one saw this coming, and look what happened. So these are the inflection points that we talk about. Again, I'm not saying that this is going to happen during this year, but this caught a lot of people off guard. So this is potentially what could happen, what has happened, where things feel the worst, investors are ready to throw in the towel, the data changes, the Fed pivots, and you get this complete inflection point where you went from this gross bear market to a booming bull market. All right, this is more fresh in investors' minds. So again, Post World War II, you're getting the 3, in this case, 5, 10% plus drawdowns with these bear market rallies in between. And notice how this was more prolonged. So this was the tech bubble crash. And you can see this was just a choppy, messy bear market that gave a lot of people false starts. So you're getting these pretty huge bear market rallies to be followed by even steeper drawdowns. So investors were probably pretty beaten down right here, given this whipsaw, and then we bounced off a bottom. And then looking at the financial crisis, which was still fresh in a lot of people's minds as well, and you got this nasty 37% drawdown. Of course, the world was melting down. This was very much global. Banks were failing. The government was throwing the kitchen sink, trying to maintain order and liquidity in financial markets. I'm not saying we're at that point now, but this is about as messy as it gets. And notice that this lasted a couple years, so 2.5 years. Again, you've got 5 in this case, nasty drawdowns, some bear market rallies, but not as intense as 2000 to 2003. And then the bottom was in the spring of 2009. And again, investors at this point were so beaten down. Many of them had a tough time getting reinvested. So this was closer to the start of my career. And I remember there was just a lot of people that did not trust this move higher. They were sitting in cash. They were dragging their feet. So this is another reason why we pay so much attention to how investors are feeling, because when investors feel the worst and they're beaten down and they're ready to throw in the towel, that's often an inflection point. And it's not the data point, but if you take that in a series of data points, it's not a bad thing to be doing the opposite of what the broader sentiment is. And right now, sentiment is very bad as well. You know, I've said this before, but people feel worse now than they did during the COVID sell-off of spring of 2020. So as I alluded to, the pain in September and the pain this year really is not specific to equity markets. Bonds have been crushed as well. And look at some of these crooked numbers. I mean, so this is basically a snapshot of various bond exchange traded funds. And there's a theme here. The longer maturity bonds, the longer duration bonds that are most sensitive to rates going up have been absolutely smashed. And look at this extended duration treasury. So these are US treasury bonds, but they're 30-year maturities. They're down almost 40%, which is worse than the NASDAQ, worse than a all equity tech index. So these moves are historically ugly, unprecedented really, but this is what can happen when you're taking interest rate risk and duration risk and you're caught off sides. Rates go up and these bonds move like stocks on the downside. So I'm really not a fan of betting on the long end of the curve, and it's not anything to do with this environment. I don't want to turn a historically safe asset class like bonds into a risky one, and I feel like that's what an investor can do when they're taking these large active duration bets. So we want to stay away from this area here. Now, if rates are moving down, then this can work in your favor, but this is just a wide range of potential outcomes that, again, you don't really want to expose yourself to in a historically safe asset class. And then kind of corporate bonds, preferred stocks, even foreign bonds junk bonds are all around this 15% to 18% down range. You can see corporate bonds. This is a popular corporate bond ETF, down 22%. That's pretty ugly. The place to be this year, if you're going to be invested in bonds, is in the shorter duration, the shorter maturity stuff. 1-year US Treasuries yield to maturities are over 4% right now. Of course, that could change, but I wrote a blog a couple of weeks ago about the silver lining this year has been there is a reasonable place, a safe place to get a reasonable return on cash, which hasn't been the case for the last 10 years. So if you're looking for a silver lining, if you have idle cash, check out that blog post. And a Cliff's Notes version is shorter dated US Treasury notes, the most liquid market in the world. You can sell them if you need the cash, but again, yield to maturities of over 4%, which is a decent proposition when you're looking at some of these crooked numbers in longer duration bonds and in equity markets. So this might be hard to see, but continuing the theme of this being the year of the 180, What this is negative bond yields in red for global bonds. So these are all developed, some emerging markets, but this is a basket of global country-specific bond yields. And you can see 6-month to 50-year bonds, and you can see the various countries here in the left margin. Now, the key takeaway is red means negative yields. So back in May of 2020, you could say about half of this chart, half of the countries on this chart had negative bond yields, right? Look what it is now. September 22 of 2022, virtually this entire matrix is green now, with the exception of Japan, which hasn't really seen inflation. But this is a coordinated central bank tightening regime right now. Everybody's raising rates to tackle inflation as we come out of the pandemic. There's all these imbalances. So again, this is a complete paradigm shift from what we've known, especially in Europe. I mean, in the US, rates were always low, right? You can go back here and see rates were less than 0.5% on the short end and less than 1% on the 10-year, but they never went negative. And to go from, let's just pick a country here. I think Germany's had some pretty drastic moves. Looking at a 10-year bond in Germany, now 1.95%. It was negative about 0.5%. That's a massive move. So again, this is just a complete paradigm shift. So this is the US Treasury bond yield curve from 2021, so the end of 2021 to the end of September. So end of 2021 is red, and the blue is about a week ago. So just look at where rates were at the end of 2021, extremely low. This was more than normal for the last handful of years. And it just a complete, again, year of the 180 shock. I mean, these are, I've never seen moves like this in my career. I don't know if we'll ever see moves like this again. But to go from 0.4%, 0.39% on a 1-year bond to 4.15% is just unprecedented. The Fed can control this part of the yield curve. So the shorter end, 1 month to 2-year, call it. So this is going to correlate very closely when the Fed increases rates. This long end does not necessarily mirror what the Fed is doing. It might be loosely correlated, but this is more tied to growth and inflation. So if we get a recession, of course we could be in a recession, but if we get a growth shock or if something breaks, you would expect these yields to go down. If inflation goes down, you would expect these longer dated maturity yields to go down. And the yield curve is obviously inverted, which is not a sign of prosperity. That historically is a sign that you are in a recession or a recession is about to come. So this is not normal. A normal yield curve, these longer maturity yields would be higher than the shorter end. But again, the takeaway here is the dramatic change from less than a year ago, about 9 months ago, 9.5 months to where we are currently. Now, there is a silver lining here. It's impossible to project equity market returns. Some people say you can do it if your run rate is long enough, but it's impossible in the short term. That's not necessarily true for bond returns. So empirical evidence would suggest that the best predictor of forward bond returns is the starting yield. Okay, so what this is, it's a measure of 7-year forward bond returns here in the y-axis. So right here in this left side where my mouse is. So this is forward 7-year annualized returns ranging from 0 up to 16. And this is the starting 10-year yield. Okay, so we're in decile, between decile 8 and 9, and know that this can change. We're closer to decile 8. So let's look at decile 8. So how this reads is based on our starting 10-year yield of almost 4%. It's just under 4%. Forward 7-year annualized return historically have been 5.3% every year. And this is from 1976 to 2015. Okay, so as starting yields tick higher, you can see the forward returns become better, right? So let's say yields, I'm not predicting this, but let's say 10-year yields tick higher and they reach 7%. Well, forward 7-year returns would be almost 8% on an annualized basis, 8% a year. So this is important for many reasons. Again, fixed income finally has income. Starting yield is a really good predictor for forward bond returns. And it's not just true for US Treasuries. It's also true for corporate bonds and high yield bonds. So starting yield is a good place to estimate forward returns, but it's also another attractive option in the opportunity set of investment, right? So there's this acronym called TINA. There is no alternative, TINA, that has been almost gospel the last 10 years. And the genesis behind TINA is there is no alternative to equities. So as rates have been historically low, I'm going to go back to this slide. As rates have been historically low, bonds have been somewhat unattractive for investors, right? If you could park money in a 2-year treasury and get 0.73%, or you can park your money in a US tech stock, right? If you could buy QQQ, which is a tech ETF that has gone crazy the last decade plus, averaging 15% a year, let's say, if you're looking at that opportunity set of investments, QQQ, the tech index, looks much more attractive. Okay. Fast forward to 2022, that might not be the case anymore. A rational investor might look at the opportunity set out there, inflation high, rates going up, markets going down, a lot of geopolitical risks. The Fed is hell-bent on breaking something. You might say, hey, this 1-year treasury at 4% is an attractive trade for me right now. I'm going to forego buying equities, and I'm going to put my money in a 1-year treasury. Now, I'm not advocating people do this. When you look at our asset allocation, Pure Portfolios is majorly underweight equities. We're overweight short-term bonds. So we've done a variation of this, but that's an important lesson. It's not making decisions in a silo. A professional investor, a savvy investor, looks at the opportunity set that's out there and makes their allocation decisions. And again, the year of the 180, this has all changed. There are attractive alternatives to equities. So it's been said, this acronym TINA, there is no alternative, is dead, because there is an alternative now. Okay, inflation, everybody's favorite topic. So this is us taking our cues from the market. And what this is, everyone has their own opinions on inflation because it affects us all in different ways, but it does affect us. And everybody's inflation number is different because we spend money on different things. We all live in different places. Inflation is calculated in a medieval way, so the data is very noisy. So we all have strong opinions on inflation, which is why we like to take our cues from the market and look at what the market is pricing in for inflation expectations. So basically what this break-even inflation rate is subtracting the yield of an inflation-protected bond from the yield of a normal bond or a nominal bond of the same maturity. So what we're doing is looking at a 5-year tip minus the yield of a 5-year treasury, okay? And that implies or gives us a inflation expectation going out for 5 years. And you can see this is a positive trend because this break-even inflation rate currently sits at 2.38%. Okay, so the market participants that are voting with their capital are basically pricing in inflation of about 2% over the next 5 years. Okay, and this has come down from this elevated inflation reading from a couple months ago. So that's a good trend. And also, this is very consistent with the Fed's long-term 2% inflation target. Okay, so if you look at this 2.38 number, which is what the market is pricing in now for 5-year inflation expectations, this, if you draw a line right here, this is very consistent to what inflation has been over the past 20 years. So this is a good sign. Stable, anchored, predictable inflation. This, not so much, but the trend is positive. So this is something to watch. So everyone has an opinion on inflation. Everyone has an opinion on what the Fed does next. This is how investors are voting with their capital. This is the 5-year US break-even inflation rate. And I just threw this in here. People are saying that the Fed is going to continue hiking until they break something. Okay, housing might be that something. I'm not sure, but this is a huge collapse in mortgage applications, right? So this is mortgage application activity for people buying homes. And this has fallen off a cliff, very consistent to COVID. And this is true for new home sales and existing home sales. So when we talk about the Fed breaking something, a lot of people are looking at the real estate market. And of course, this is a symptom of many things. Inventories are still low. Mortgage rates have shot straight up. There's a lot of uncertainty out there. So people are less inclined to make a big ticket purchase or make a big financial transaction, which certainly buying or selling a home qualifies as that. So this is something that could break. And a lot of people are rooting for something to break, because that would mean the Fed would have to stop. And the Fed seems to have blinders on. They have tunnel vision, and they seem hell-bent on hiking until something breaks. So we're keeping a close eye on housing, because again, that affects a lot of people. And speaking of something breaking, so there's been a lot of talk about a strong dollar, and this is where we're currently at. So basically what this is the 6-month percentage change of the dollar versus a basket of other currencies. And the dollar's up against every other country's currency this year, and it's up quite dramatically in some cases. Now, the problem is dollar strength is often associated with crisis, okay? And the dollar going up is usually a flight to safety. So the Fed's kind of leading the global charge in hiking rates. People want the appreciation of the dollar. They want to capture the higher interest rate spreads, right? We looked at a German 10-year bond, 1.45%, US 10-year bond, a shade under 4%. That's a pretty good trade for a German investor. You're getting the tailwind of the appreciating dollar. You're getting a higher interest rate on a 10-year bond. So a lot of investors are thinking along those lines, hence the strength of the dollar. The downside is when the dollar is strong, things can break. So 2015, that was associated with the Greek sovereign debt default, 2008 global financial crisis, 1998 Asian currency crisis. So when the dollar goes up, things can break, because a lot of these countries have debt denominated in US dollars. Okay. And if your currency, a currency that you get paid in, is depreciating, and you have debt in dollars, which is appreciating, that's a bad equation, because you're basically paying that US dollar debt off with a currency that's worth less, and you're paying off your debt in a currency that is worth more. So this is a problem. We're not to the levels of some of these other crises, but we're trending in that direction. So if the dollar continues to get strong, again, that could break something, which some people say is a good thing, because it would shake the Fed up and say, wake up, you need to stop with the rate increases. Now, this is really interesting, and I saved this for last, because there's this notion that the Fed's going to continue to hike no matter what happens. And the market is actually sniffing this out and saying that might not be the case. So what this is the current Fed funds rate is roughly 3%, okay? The Fed doesn't meet in October. So the September minutes from the September meeting will be published in the middle of October. The next opportunity for the Fed to increase rates is in November, okay? And just a week ago, so down here, I don't know if you can see it, but just a week ago, the odds of a 75 basis point or 0.75% hike for the Fed was at 70%. The odds of a 0.5% hike a week ago were under 30%, okay? So the market was basically saying the Fed is going to continue with the aggressive 0.75% hikes. A day ago, those percentages had fallen to 62% for 0.75% increase. And now look at this dramatic shift, and no one is talking about this. This is taking cues from the market. Now the market is pricing in only a 45% chance the Fed hikes by 0.75% in November. Okay, so what this is investors reading what's happening. They're reading dollar strength. They're reading the housing market falling apart. They're reading asset prices going down. They're reading economic data is softening. They're reading between the lines that inflation could have peaked. Signs are all around us that inflation could be coming down. Our friends in Canada saw inflation peak. Inflation went down in August. So again, everyone has an opinion. Our job is to take our cues from the markets, to have a non-emotional response to what is currently happening. I think it's okay to be bearish in this environment. There's a lot of uncertainty, a lot of negative, crooked numbers out there. The month of September was brutal. So it's okay to be pessimistic, but as we saw from some of the earlier charts, it's probably not prudent to stay pessimistic, right? History is not riddled with perma bears or perma pessimists enjoying investment success. So yeah, it's okay to be uncomfortable now. This is an uncomfortable environment. This is the 6th worst calendar year returns that we've had in 95 years. We're all going to feel pain. Our job as professional investors is to underweight risk, to take risk off the table, to mitigate the huge downdraft, the huge negative 35% outcome. But it's not necessarily prudent to stay bearish. So again, you want to stay flexible. You want to be able to change your mind, because these inflection points, like we saw in the spring of 2010, like we saw in the fall of 2002, and the third quarter of 1982, they can come without warning. They can often come when things feel the worst. So it's okay to feel uncomfortable. It's not okay to stay hunkered down and think the world is going to end, because things always feel horrible in the moment. Every crisis feels like the worst thing ever. Fast forward a couple of years, you might look back and say this was an obvious buying opportunity. So thanks for checking in. Thanks for listening. I know this went a little bit long. There's just a lot to cover. If you have any questions, feel free to reach out to us at Pure Portfolios, insight@pureportfolios.com. Thank you.